Hi, thanks everybody for coming. I'm going to talk about euro-dollar. And well, for those of you who don't know me, and many people here know me for many years. So I used to be a retail trader and a computer programmer. That's what I worked for a living. I founded Forex Crunch back in 2008, and the focus of the site is fundamental analysis, what moves markets in the longer term, and I touch only a bit on technical analysis. And apart from Forex Crunch, Leon and myself are hosting a new podcast called Market Movers, and recently began with FXStreet, the morning show every day at 10. So this is what we'll cover today. Basics. Euro-dollar, what moves it in the long term, what are the recent movements in the past year or so, which have been quite dramatic, changes in the reaction mechanism. I'm going to explain some things that might be counterintuitive, but that's how it works, and my wrong predictions for what lies ahead, and then a Q&A session. If you have any question, quick question during the session of something you didn't understand, please just shout out, but longer questions, we'll leave them to the end. Okay? So, basic facts. Well, euro-dollar is the most traded pair, of course. The largest economy, the US economy, is $18 trillion. Eurozone economy, 10.6 trillion. So, and after that, Chinese economy, which will probably surpass the Eurozone economy quite soon, but the Chinese yuan is not as traded as the euro. And then we have Japan very far behind. Also in foreign exchange, in the spot market, euro-dollar is almost a quarter of trades. And I know as a publisher of a website, every small article I write about euro-dollar gains much more traction, much more traffic than any thoughtful, intelligent thing I write about the New Zealand dollar, for example. After euro-dollar, we have dollar-yen and pound-dollar. And if you look at two currencies where we have 87% of trade is the US dollar against another currency. And the euro, well, it's far behind, but also a third of the trades include the euro. Okay? And the dollar is the king. When we talk about currencies, we talk about major pairs, we talk about the dollar. When we talk about currency pairs that don't include the dollar, like pound-yen, euro-Swiss, we talk about crosses. Just terminology also reflects the importance of the United States dollar. Why is the US dollar so special? First of all, the United States is the world's superpower, of course. It's the world's reserve currency. Many things are quoted in US dollars. The most important thing is, of course, oil prices, basic energy. And this guy says he'll make America great again. But I think if you look at foreign exchange, US dollar, of course, is still king. Also, the euro is special. It's a monetary union of 19 countries. It was more a political project than an economic project. So they were supposed to follow all kinds of rules. The biggest countries broke the rules before all the rest. And some countries cheated their way in. So it's the political thing which needs to work economically and doesn't always work. The ECB, the European Central Bank, which sits in Frankfurt, has a one-size-fits-all policy, but the countries are quite different from one another, so that causes tensions, troubles, and movements in currency markets. The euro, well, in recent years, of course, we had government debt with Italy, Portugal, and Greece. It was a different story here in Spain and also for Ireland, where we had private debt, of course, mortgages. And it's one big happy family, sometimes with closed banks like here in Greece, sometimes people at odds. And this guy's a bit lonely, but usually they reach some kind of agreement after 17 hours of talks. So anyway, all these things, which we won't dive into the debt crisis, it's huge, but it also always causes interesting movements, interesting headlines. Euro-dollar, well, as I said, United States, most important country in the world. euro very complicated. That means lots of noise, lots of news, which means lots of noise. And how can we separate it? Well, just look at the bigger picture, at the long term. So for those of you who are more interested in technicals work, for instance, this trend line, if this works, never mind, use the finger. This is a trend line that Dan pointed out to me a few months ago. It goes from 2005, and then it was broken quite sharply. And so if you trade on the long term, technicals work as well. We have other lines that work here. If you look in the shorter term, it's a bit more complicated, but that's how things go. So, what are the long-term influences on euro-dollar? Well, it's people like the three Americans we have here, which transfer money from the United States to Europe and the other way around, and exports, imports, exports, trade, services. Then, of course, what impacts more markets is interest rates. Then money printing, we'll explain how that works. And expectations, of course, speculation. Let's call it this way. Most of the market is speculation, what we expect to see. So, in terms of trade, we have a real imbalance. There's much more flow from the Eurozone to the United States. The Eurozone exports a lot to the United States. 13% of Eurozone exports go to the US, and 6% of Eurozone imports come from the US. It's very unbalanced. In general, the Eurozone has a surplus, 22 billion euros, more or less on a monthly basis. The United States has a huge deficit of 40 trillion. What does this mean? This means that the gap is money flowing from the United States to Europe, and in theory, euro-dollar needs to go up. If it were only real trade, the euro would have been much stronger, okay? So when we have no news in the market, euro-dollar goes up. So for euro-dollar, no news is good news. When there's no speculation, which is quite rare, of course, because we're here, everybody's here to speculate, then no news is good news. And then let's move to the next thing that moves markets. In normal times, in the good old days, we had normal interest rates, so interest rates, gaps in interest rates moved markets. So if we had a higher interest rate in one country and lower in another one, money would flow towards a higher interest rate. But this is an ugly contest for quite a few years. It's 0.14 the effective interest rate in the United States and 0.05 here in the Eurozone. This doesn't mean there aren't movements. Interest rates, well, this chart goes only up to 2011 for the United States, but now we're in 2015 and it's still flat, dead on the ground, 0% interest rates in the United States. In the Eurozone, it was more interesting in the post-crisis period. We had this guy, the former president of the European Central Bank, Jean-Claude Trichet. He raised interest rates twice in 2011, which I think is a very bad idea because it sort of put fuel on the fire for the second recession here. And then came Mario Draghi, the current president, Italian, which I think does a better job. He cut interest rates quite a lot. So here are the interest rates in the Eurozone. This is before the crisis. They were at what we call normal levels, and now they fell to 1%. And then this is Jean-Claude Trichet, and then Draghi putting them down, 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 including a negative deposit rate. What does a negative deposit rate mean? It means that if you're a commercial bank, a Caixa, Barclays, whatever, and you have spare cash and you want to put that spare cash with the European Central Bank, you're basically punished. If you put 1,000 euros, after 1 year you get 998. That's a negative deposit rate. And this, of course, causes money to flow out. That's the idea. It's supposed to flow into the real economy. Some of it is going into speculation. The third topic, of course, that moves markets, it's relatively new. It began in Japan in the past, but now many central banks do it. Money printing, they don't use this kind of printer. It's much more electronic these days. So what's the idea of money printing? The central banks create money, enlarge the balance sheet, they're allowed to do so, they have the authority, and they use this fresh money that they create out of thin air to buy long-term bonds. So this lowers the long-term interest rates for 10 years, for 30 years, and then it's supposed to give more certainty to the markets, allow lending in lower rates, allow people to take mortgages, refinance mortgages. That's the idea of creating money, and quantitative easing, that's the name. Very complicated name, but basically central banks just create more money. Now, many people fear that creating money, of course, causes inflation. We had these pictures back in the early 1920s in the Weimar Republic in Germany, and we had recently in Zimbabwe 100 trillion Zimbabwe dollars. That's how hyperinflation looks like, but we have all this money printing in the United States, in Europe, in Japan, in the UK, and so far, I can't really see the inflation. Why don't we have inflation? Why do we have deflation here in the Eurozone and very low inflation elsewhere? Banks are deleveraging because banks lent too much money in the good days, and now they're a bit suffocating, strangled for cash, and they're sort of squeezing their assets. They don't have anyone to lend to, so even if the central bank provides lots of money to banks to lend out to the real economy, there are not enough good businesses to lend to, not enough people that want to take loans, and households are deleveraging. For instance, here in Spain, it's one of the worst cases that people took out huge mortgages, now they have to pay them back, and they're lost their jobs, and they've lost sometimes their houses, and they still need to pay it back. So also, people are not taking new loans because they're still paying back the old ones. And another thing is hyperinflation is always, as far as I know, related to a big political event, to a disaster. So in Germany in the 1920s, they had to pay war reparations, and France invaded small parts to get those reparations. In Zimbabwe, we have a dictatorship. It happened in Hungary after World War II, after the country, of course, was devastated by the war. So all the scenarios of hyperinflation because of printing, so far didn't prove themselves. The United States, there are differences between the United States and Europe in terms of money printing. So in the United States, each QE program, there were 3 so far, each one was followed by reinvesting proceeds. What does it mean? The Federal Reserve decided to expand its balance sheet to create money out of thin air and buy bonds. And once this program came to an end, it didn't squeeze back. It didn't drain the money back in, but just maintain this same level. It's like an idea from real life here, but well, it's like we're running together. So it's like they accelerated their speed, and instead of running backwards, they just continued running at the same pace, or stayed in the same place. Okay, so each time they did that, they maintained the same level of money in circulation. The balance sheet was never squeezed. Along the way, they did these twist programs. It's a bit more complicated. They moved investment to longer-term bonds. So this is how the balance sheet of the Fed looks like. QE1 just after the crisis, boom, QE2, and QE3, which ended in October of last year. All in all, 4.5 trillion. This is a percentage of GDP, of course, goes. In the Eurozone, it was a bit different. First of all, they didn't want to print money. They just wanted to make it easier for banks to lend it out. So they announced these LTROs, lots of buzzwords, long-term refinancing operation, basically lending cheap money to banks so that these banks will lend it to the real economy. They had 3-year loans, but when these loans were returned, when they expired, money returned to the ECB and it served as monetary tightening. So it's this person that runs forward and then actually runs backwards. Until they announced a real QE program, a real money printing program this year. So this is the balance sheet of the ECB. This is before the crisis. This is the first and second LTROs, and then we had it squeeze back down here. And this is already the QE program with prospects for 2016 and to infinity. Okay? So if we sum up interest rates in QE, we have interest rates now in the Eurozone, that's the purple line here, falling below those of the Fed. It's the sort of green yellow line. And in terms of the QE, we had, as a percentage of output, a percentage of GDP, we had right here, the ECB is one fell below the Fed, and then now it's beginning to change course. Now we're going to have more money printing. This is a percentage of GDP. It means relative to the size of the economy. Here. And of course, the biggest thing that moves markets is speculation. Talk is of course cheap. It's better to talk than to act. It's free. So we had in the United States quite a few cases of that. We had Bernanke talking about QE3 in 2011, dovish at Jackson Hole. We had 2 years ago what was called as the taper tantrum. We just began talking about printing less money, and what happened is markets panicked a bit. And then Janet Yellen, the current head of the Federal Reserve, she talked about raising rates 6 months after QE ends, and that of course also caused a lot of speculation. And then we had the patience, always have to be patient before raising rates. In the European Central Bank, it was, I think, more exciting. First we had Trichet saying strong vigilance. Everybody knew that rates are going to rise next month. It already caused some movements in markets. And then we had Draghi's whatever it takes speech. In the summer of 2012, Eurozone crisis was at its worst situation. Euro-dollar was at almost 120, and he had this speech in London just before the Olympics there, saying, we'll do everything to preserve the euro, and you'll see it'll be enough, something like that. And that marked the bottom of euro-dollar. The next month he announced a new program, OMT, another buzzword. They're really good at that. And but this program, the OMT, was never used. So just by saying we are here, we managed to create a lot of confidence. Of course, the stock markets here in Europe went up, and euro-dollar went up, and there was much more confidence. We also did that last year. In general, central banks prefer showing the bazookas, as I think it was John Paulson or Hank Paulson said, and not the confetti. This is an event. See, my world is not that boring. Sometimes you have people jumping in and throwing confetti, so they prefer using the bazooka drill. This is the bottom. This is the 120 in July of 2012. The whatever it takes speech by Mario Draghi. It's the perfect usage of verbal intervention, just showing the bazooka. Okay, so we talked about euro-dollar facts, long-term influences. Let's talk about recent movements in the past year or so. Maybe does anybody have any questions so far, or leave that for the end, or no? Yes? No? Okay. So this is the chart of euro-dollar from this is May 2014, and it collapsed quite a lot until the spring, and then it stabilized. So what happened? In May 2014, euro-dollar was almost 140, and then Mario Draghi said, "We feel comfortable to act next time." Means cutting the interest rates, setting a negative deposit rate, basically punishing banks. In June, that really happened. He was forced not only to talk but also to act. It was already 137. In September last year, it was already a bigger fall. They cut the rates for a second time to their lower bound, at least for now, 126. And in October, the Federal Reserve finished basically its quantitative easing program, and we're already at 125. In December, we had talked about the ECB printing money, and then we had 121. But since then, it's more like a sort of balanced. We had in January, had a lot of action. Hope anybody and nobody traded the euro against the Swiss franc. We had what I called, what everybody else calls, so the SN bomb. The Swiss National Bank decided to say, well, never mind, we're not going to support euro Swiss at 120. And then we had the big announcement of QE that the ECB is going to print 60 billion euros every month for at least a year and a half, €1 trillion for everybody. Okay, not for all of us, for the banks, but and euro dollar fell even more to 111. But at that point there were still doubts if it could really work or not, but in March it began quite smoothly. The Federal Reserve in the United States, began talking more about raising rates. So we have expectations for rates rising in the United States, and in the Eurozone, money is printed. So we reached the low for the year of 104.60. In April, we had it bouncing back. Why? Because we had a change in behavior, and we'll explain that immediately. So let's see what we had afterwards. In August, we had the Chinese crisis, the crash in stock markets. When I was on vacation, who makes a crisis in the middle of August? It's unacceptable. Anyway, we had roller coaster markets, and we had euro dollar rise to 117, break above the range, reach levels not seen since it's the high of the year, highest levels for 2015. In September, we had the Federal Reserve waited once again and again, and European Central Bank so far didn't change its policy. So why actually did we have the euro dollar rise when the stock market crashed? Okay, it crashed, and we have similar examples. And this is the counterintuitive part of the top. We have changes in behavior of markets. Okay, we have normally we have good economic data. We have a currency rise. So if, for example, in the United Kingdom, the unemployment rate falls, it's good news. The pound sterling rises, right? Or if we have here in Europe inflation rising, distant example, then we have expectations for higher interest rate, and we have the euro rising. That's normal behavior. That's what you would expect. That's intuitive. If the economy is doing well, the currency is doing well. Okay? But life is complicated. So, until the crisis, we'll start from Japan because we had this reaction in Japan first and it's still relevant. Japan, the population there isn't really growing, even shrinking. They had this second lost decade, and they have low interest rates for years and years and years. Okay? Interest rates were low, money was lent quite cheaply, of course, in Japanese yen, that's the currency, and investors, speculators, took this money and spent it on riskier assets. Lent money in Japanese yen, took it abroad usually. Okay, and this includes currencies with higher interest rates. So we had the famous carry trade, especially Australian dollar against the yen or the New Zealand dollar against the yen. We had interest rates of over 8% in New Zealand and over 6 or 7% in Australia. And in Japan, we only had 0.5%. So when everything's going well, just lend money in Japanese yen, invested in Australia and New Zealand, just buying the currency. And you have this interest rate differential, and you make 6% a year, 7%. Not too shabby, right? Until the crisis comes, and then all this money goes in the opposite direction. So then if you made 6% a year, in the crash you lose much, much more, especially if it's leveraged. So in times of trouble, the money is repatriated, going back home, going back to Japan in this case. And the Japanese yen strengthens in times of trouble. Now, this trouble can come at home as well. In 2011, March 2011, we had this terrible catastrophe in Japan. 9 Richter scale earthquake, tsunami, and the nuclear disaster in Fukushima. The Japanese economy, of course, was also devastated by this terrible catastrophe. What happened in currency markets? The Japanese yen strengthened, okay, because money was repatriated. Money came back home to Japan, to the economy from other riskier assets. We even had a coordinated central bank intervention to weaken the yen to help the Japanese economy. So this is counterintuitive. Okay, we had a disaster in Japan, loss of human life and damage for the economy, and we had a stronger Japanese yen. Okay, that's how it just worked. That's the carry trade. So everybody was sort of enjoying the good times. New Zealand dollar against the yen was just going up until, boom, crisis 2008, 2009, it crashed. Also, the Swiss franc is a safe haven currency. Each time we have trouble, the Swiss banks are safe, right? We know that from politicians also here in Spain, Catalonia, that they have safe money in Swiss banks. Trouble in the Middle East, everybody buys a Swiss franc. Trouble in the Eurozone, Swiss franc. Even in Ukraine, the most recent flow of money into Switzerland came from the crisis in Ukraine. It was best seen in the Arab Spring in 2011. That was the best example as well. But Swiss franc is not so safe anymore. Why? Since that year 2011 we had the peg, we had Euro Swiss more or less defended at 120. That lasted for 3 years and 4 months until this guy, Thomas Jordan, head of the Swiss National Bank, decided, I can't take it anymore. And after months and months of no movements, almost no movements, we had this thing. It crashed a few stockbrokers. It fall of 14%, which is quite rare in currency markets. So I wouldn't call the Swiss franc safe anymore. United States, also safe haven, and recently a funding currency. United States, as I mentioned before, is of course the world leader. And the idea is, if the United States cannot lead the world, who can? It's the locomotive, it's the strongest economy, it's where things happen first. First had the crisis in the United States, then came to other places. And if we have a recovery, it begins first in the United States. That's the conception, or the concept more or less. And then the United States, the US dollar became a funding currency. Why? Zero interest rates, so you have cheap money, you can lend it in US dollars. And you have the Federal Reserve, the central bank, in Washington printing money, okay? The QE programs. We've seen the same counterintuitive reaction also in the US dollar. Weak US data, everybody thinks, okay, if the United States is weak, we're all doomed. Everybody is going down, so the United States is still a safe haven, so money flows into the US dollar. If there's good data from the US, there was, let's take risks, everybody's doing well. So the United States dollars and the United States dollar weakens. It was best seen when America lost its credit rating. S&P cut United States credit rating from AAA to AA, and the US dollar was, of course, stronger. Counterintuitive, but that's how it works. I don't trust these rating agencies too much, but they do have impact, quite a lot of impact on markets anyway. And the US dollar is not such a good safe haven currency anymore. The US is expected to raise rates at some point. This is Janet Yellen, the chair of the Federal Reserve, which is going to raise rates at some point. That's still a speculation. And the euro is a newcomer in this club of safe haven funding currencies. In the good days we had it was just another currency. We had good news in Europe, stronger euro. Bad news in Europe, weaker euro, right? We had the Greek debt crisis of 2010 and then 2012. The euro suffered. We had a resolution around Greece, higher interest rates, economic growth, stronger euro, right? But times are changing. thanks to this man with the money printing, Mario Draghi, for parking money with the ECB. So why put your money in Europe? Let's spend it elsewhere, right? And QE, the money printing scheme, the ECB, is working quite well. So you have more money flowing. So it's cheap to borrow in euros and taking risks abroad, including US corporations. They lent money in euros recently because it was just they were cheap. But then we had a similar reaction as we had in the Japanese yen and in the US dollar. Now, in times of trouble, we have, let's say, stock markets go up, the euro goes down. Because if everything is going well for the world, why you can take cheap money in euros and spend it elsewhere. When stock markets go down, like in August, 6 weeks ago in China, the euro shoots higher. Okay, so for now, bad news for the world is good news for the euro, and the opposite direction. This includes these guys. Alexis Tsipras, the Greek Prime Minister, and Yanis Varoufakis, former finance minister, was going to be here next week in Barcelona, and we had good news about Greece sending the euro down, and bad news sending the euro up. So even if the safe haven is the port of Piraeus or any other port of your liking in Greece, the money still flows in times of trouble and flows out when things are good. We've seen that in that all-night session of 17 hours on July 13th. Finally, we had an agreement. Greece is saved, no Brexit, everything's good, and the euro falls because if everything's good, let's put our money elsewhere. So this is the current behavior of the euro. Basically, the euro and the dollar, during a long period of time that they switched places, the United States dollar used to be a safe haven currency, now the euro is. But this new status of the euro is not very stable, it's relatively new. We still have the Japanese yen as the strongest safe haven. So if we have trouble, we have stronger yen. That's almost certain. Usually, when we have trouble, we have a stronger euro, but this behavior is still relatively new. Okay? And now it's time for the crystal ball to make wrong predictions. Earlier I spoke with Shoes, and he made a prediction of 107, 108 until the end of the year. And it's going to be recorded, so blame me. Let's see, the big events. Of course, I talked a lot about central banks, usually boring stuff, but we had the confetti lady, and we have, it really impacts our lives. As Jim mentioned before, euro dollars is just something that's important for your savings. So on October 22nd, we have a rate decision in the Eurozone. I believe that Mario Draghi will say something like, we are ready to act. Watch out, in December, we're going to make a move because inflation is low, and he won't get into details. He likes to provide some suspense. Usually he makes a long pause before he drops something into the press conference, and usually it's sort of on the way, half hour in. It's not in the official statement, but that's my prediction for October 22nd. October 28th, we have a Fed decision. There's no press conference. The Federal Reserve and the ECB meet every 6 weeks. It used to be every month for the ECB, but now it's only every 6 weeks. Anyway, it's for the Fed on October 28th. There's no press conference, no new forecast, and this means that they'll probably not make any policy change. So it'll be a bit boring, snooze fest, and non-event if you wish. And then in December, before Christmas, I think that's when we have more action on the cards. We have a meeting of the European Central Bank with new forecasts this time, and maybe my prediction is that they'll announce it here. So I believe that they'll announce an extension of the QE program. Currently, the ECB prints 60 billion euros every month, and it's supposed to end in September 2016, in just under a year. They might announce that it'll go on until 2017, maybe 2018, maybe like the Fed did in the past, until further notice, to infinity and beyond. Okay, so that's using words to promise something that may or may not happen without any real action now. Real action would be enlarging it from 60 billion to 80 billion or 100 billion. That means pumping more money into markets now, or in January, for example, which is basically also now for December. On December 16th, when liquidity in markets is a bit lower, but I don't think it matters too much, I believe, the Fed will finally raise rates. I know I've recorded a few podcasts here with Leo Cohen, and I'm always the optimistic one here, and he was always correct by saying we will not have a rate hike. So I'll explain why the pros and cons for a rate hike. So at the ECB, I believe that if we'll have just more forward guidance, if they'll say we're going to continue with printing money forever, that's more or less priced into markets. So this will not have a significant impact. Okay? If they will say that they're printing more money now, it'll of course weaken the euro. And if they don't do anything, it'll of course strengthen the euro, because more money printing means less value for the euro. My bet for the Fed is that in December we'll have the historic move of raising the rates for the first time since 2006, since the days of the bubble in the United States, also here. It'll probably be what they call a dovish hike. That means the Fed will say, okay, we raised the rates, but now we're afraid of our own shadow, and we'll wait and see, we'll be data dependent, things like that. But it's still a big move because it's not priced into markets. According to the recent bond market expectations, it's 60% against any rate hike in December. So if we do have a move, one of historic nature, then I think we'll have a stronger US dollar. US interest rates are at rock bottom for already over 6 years, and this is of course great for the economy, for those investing in the S&P at least. For those in stock markets, which is not all the people in the United States economy, this is a better picture of the US economy. This is the blue line here, is the unemployment rate, so we've seen it rise from more or less current levels up to over 10%, and then falling gradually down all the way. Well, this chart is not really updated, but now the unemployment rate in the United States is at 5.1 in comparison to 11% here. But the red line is wages, okay? Money. So if you go to work, more people have work in the United States, but they don't have pay rises. Okay, so we had pay rises of around 3.2, 3.7 here in good days, and then we're here in the new normal, if you wish to call it, the new mediocre of around 2%. So the real economy, it's more people are in the workforce in the United States, but wages are not going up. So why do markets regarding the Federal Reserve, why do they not expect a rate hike? First of all, inflation is very low. We're inflation is around 0% in the United States. Even core inflation, if you exclude food and oil and gasoline, I mean, if you don't drive a car in the United States and you don't eat food, then it's around 1.8. Actually, it's not the case. As I said before, wages are not rising. So something I didn't mention, the Federal Reserve has two mandates. It has to maintain inflation of around 2%, and it has to aspire for reach full employment. In Europe, the ECB is only responsible for inflation, headline inflation. So it doesn't care about employment, GDP, gross domestic. It doesn't officially, of course, everything is correlated. So back to the US, inflation is just too low, wages are not rising, China is slowing down, we've seen the crash in the Chinese stock market, and well, I think it was quite expected that after so many years of strong growth, China would not grow its 8% every year, and I think 3% is good enough. And many organizations, such as the International Monetary Fund, are warning. Okay, the International Monetary Fund didn't do such a good job with Greece, but they still have impact on markets. They still, if they say, be careful, it might impact the Fed. Why did they not want to rate hike? Because during those days, current days of low interest rates in the United States, many corporations in emerging markets, and it's not only China, it's the Philippines, it's Mexico, it's Brazil, it's Chile, took loans in US dollars, and if the dollar rises, if interest rates rise, then it'll be a problem for them. Another reason not to raise rates is because the Fed is what's called dovish. They tend to, if they're uncertain, they want to help the economy more than take a risk than to choke it. And of course, they don't want to backtrack. They don't want to raise rates now and then do the click Control-Z undo button and lower them again, because it would hurt their credibility and of course cause a mess. But after saying all that, here's the case for raising rates. First of all, inflation lags employment. So first of all, in an economic recovery, you have more output, the economy is working harder, and then when companies get more confident, they hire employees, and inflation comes later on. In theory, the Fed needs to be what's called ahead of the curve. It needs to act before it's too late. Okay? Another thing is bubble trouble. The Fed is already, I think, rightfully accused, at least it has part of the blame for the previous bubble. We had low interest rates, and we had housing bubble. We might have now a bubble in stocks, and they don't want, and we have bubble of lending in US dollars in emerging markets. So, do you want to give, if you're a barman and you see someone who's a bit tipsy, and he wants another drink, and you tell him no, of course he'll be angry with you. But if you do that later on in the night, it might be too late. You might cause more trouble, get into a fight. So perhaps it's better to stop before we're in trouble. And as I mentioned before with the wages, low interest rates are not really helping the real economy anymore. They did help. It helped stabilize the situation in the United States after the crash. But now many companies in the United States are taking money, cheap money, and buying back their stocks. So this money is going in circulation in the financial sector and not really helping. I see it like some kind of medicine, maybe a better example than the bar. Loose monetary policy, low interest rates, printing money is good, is medicine, but every medicine also has an expiry date, and I think we're very close to this point, but who knows, another crash in China, and for all the reasons beforehand, we might see them refrain from action. So, my bet, of course, it's recorded, then we'll see new lows in euro-dollar. Currently we're at 112, and then I should have updated this later, maybe next year, so I think we'll have 107, 108 towards the end of the year, and then after it's over, we'll have changed course. Why? Because the expectations for rate hike in the United States are still boosting the US dollar, but I believe that around a month after the hike, after the news is in, we'll begin seeing euro-dollar rise back up, because once we have less speculation, as I said in the beginning, no news is good news, and once we know the path of interest rates, once we know it really happened, and the world hopefully doesn't collapse, then euro-dollar might start a nice recovery, and we can all visit the United States later next year. But it's cheaper for us. So yeah, that's what I've prepared for you guys today. Now time for questions.